Ladies and gentlemen of the crypto space, we're live on a Monday, September 29th at 11:30 a.m. And today is Purpie Cirky Day. We talked about the Purpie Cirky on Friday, but we're going to talk about the Purpie Cirky more again today because it looks good. Now, obviously, you see two Purpie Cirkies on this chart. It's a little bit of a non-impressive presentation from a weekly standpoint, but if you go into the daily standpoint, that's where I drew the Purpie Cirky from. This one, not so much. This one should be bigger. The whole thing is the perpy circuit. But here we have our interaction from a daily standpoint that is constructive. So look at this big fat green. These levels up here are levels of previous resistance. So notice the resistance point here. Notice an interesting resistance here. And then you have a resistance hit here. And you have another resistance hit here. So it's an interesting level. This level of $4,094 has been hit a couple of times, even dating back, I would argue, to 2021. So you have your rejection here as well. This is a breakout rejection. This is a breakout and a rejection. This is the big one. This is the big one because this is a larger interaction where there's multiple days involved. In fact, there was multiple weeks involved, 2 weeks at least, where you had a break above 4,094. But it was a failed breakout. So this is ultimately rejection of that specific level. Fast forward after one, two, three, four, five interactions with that level, failure to get above it. Now we break out above it and we have this perpy circuit. But maybe if you want to compare from a daily standpoint, you can encapsulate the entire thing. So you have your breakout above, and look, and we're comparing these two perpy circuits. So this is the breakout above back in 21, and it broke down. We didn't really see much support in there from a daily standpoint. There's a couple of candles that wick below, but that's where we are. We're in a repeat of Q4 of 2021, which is so interesting and in so many ways, particularly because that was very much end of last cycle. Yes, I said it. That was the end. Q4 of 2021, you had to wait until basically now to get back to where you were in Q4 of 2021. And we are in the subsequent Perpy Circuit, which is an identical or very similar structural setup, technical setup to what we had for Ethereum in Q4 of 2021, except now we just had our first interaction with the 4,094 level after breaking to the upside through it in August, which is basically a month ago. And we bounced off of it. Okay. Early constructive observation to be made. Bounced off it. Let's see what it does. I don't take bets. I don't take directional bets. I don't give a shit if it breaks up, breaks down, breaks left, breaks right, forward, back, whatever, what have you. But it's something to observe. Of course, I want to see the market go up. Well, I'm equally okay with the market going down. It doesn't matter to a person like me and the way I manage things. But I do like to know. I don't like to be surprised. If I know the market's going up, great. If I know the market's going down, equally great. As of right now, this is constructive that there's at least support. Support, as I've said historically, is a position of weakness. A breakout and a retest and a higher high is a position of strength, confluence of strength. This is not strength. This is weakness. This is the retest. See, break. Can't really see it on the weekly, but let's draw it on the daily. But here's your breakout, retest, and now you need to see the higher high. And there's your trifecta of bullish confluence. We are not there yet. Welcome to Q4 2021, lads, because that is where we are from Perpy Circuit Land. Bitcoin back above 114. A little bit more constructive on Bitcoin from a level standpoint because we are way past 2021 levels. But we do have this interesting level of 108,343, where we had rejection, 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 and basically this entire breakout. And thus far, with this breakout, we have support, support, two interactions of support. So we have one, two, three, four rejections, followed by two supports. So that's a nice change. That's an expression of support following previous rejection as resistance. Now you obviously need to see the higher high for confluence to the upside. Not much else to write home about technically. Aerodrome still a little weak. It was around 99 to a dollar, back up to about 107, 108, give or take. Curve was at 70 cents a little bit earlier. Certainly a lot of constructive things to talk about technically for Curve's chart. I posted that on X. I don't necessarily need to recap. I retained my original drawings. You got the larger inverse head and shoulders. You got this small one, which is very nice. At least technically it's there. And then you have a series of higher lows. One, two subsequent higher lows. And you got this initial series of lower highs. This lower highs are an expression of resistance on the weekly 50. One, two, a little bit more constructive on the daily because you have your support down here of the weekly 100. Now is where decisions are being made. Clearly, we had the breakdown. We didn't even interact with the weekly 100, so that is a little bit stronger than wicking through the weekly 100, for example. But now you have your bottom side retest of the 50 SMA back to the upside. So we get to see a little bit of resistance thus far. This is a daily candle chart. So thus far today, there's a little bit of friction trying to get through it. Do we get through it? I don't know. Yield basis is doing its thing with its it's not a TGE. What is it? Oh, it's launch. They're selling what $5 million worth of YB at $200 million valuation, which is wild. It's not really early, is it? If you got in at 2 million or 20, even 20 million is much earlier, 200 million valuation. All right, curves run around at 1+ bill. There's much bigger protocols in the multiples of billion-dollar valuation. So it could still be relatively early. Get your 10, 20, 30x, 40x, 50x over the next years. Interesting. I know my 2 cents how I will engage with that protocol, but in my opinion, that is got to be the biggest thing going on right now across crypto. This whole perpdex meta is noise to a person like me. We're talking about what Hemi and Aster and Hyperliquid. I just don't give a shit. It reminds me of stuff like this. I just don't care. When I see a protocol tying into banks, bank settlement, I don't care. I don't care about perpdex meta. I don't give a shit. It is boring. It is small ideas. And yes, small ideas can make a lot of money because there's a whole lot of people out there that are highly influenced by small ideas like fucking perpdex. I mean, literally GMX was a big deal back last cycle and it's nowhere to be found. And relatively speaking, compared to what Hyperliquid did, absolutely massive, monumental volume of activity. I just don't care. It's a fucking perp dex where degenerates could gamble on price directionality, up or down. I just, I don't care. What I want is fintech products that are actually useful for maybe um, business needs. Like, how do you finance net settlement on a purchase? If you're a wholesaler or retailer, if you're a retailer buying from a wholesaler, you usually get net terms, net 10, net 20, net 30, 30-day for settlement. So you need loans, you need short-term loans, and that's where all this comes into the picture of how all of this is related to normal standard everyday financials. You need 30 days worth of credit. Okay, now we have disintermediated credit as compared to what banks used to offer. You could skip the banks now. That I'm interested in. That is very, very interesting to me as compared to silly, transitory perpdex meta. Um, Anything interesting in my comments? Found this dude, Cryptic Trades, who had a nice post about what's the whole point? whole point of investing. He said it very nicely. That's in my X post history, my timeline. Take a peek. Never force a position. Never force a sneeze. Never force a position. Well said. I don't really trade, but it's good words. We hit the Perpy Circy. Yo basis is doing weird things. It has such a very big interest, decent social media presence. Could be interesting. This could be very interesting. I sure as hell think it's interesting. And there's our stream. Anything else that I talked about? Santiago always with some good commentary, very big picture type thoughts. Crypto is in a secular trend. Yeah, at this point, it's obvious companies will adopt it because it's better, irrespective of macro and crypto asset price. That's the whole point. That's such a big statement right there. Everyone's so obsessed with when's top? Is it going to crash? Just fucking buy more assets. It's in a secular trend. In the future, you're gonna look back and be like, thank God I bought assets. That's the equation. That's why rule number one is so meaningful. Rule number two is just trying to get the best price possible so you don't overpay. Never want to overpay. Big trend in the United States with socialism. And I don't know. It's pretty simple for me. I don't want to pay for it. So it seems, you know, you'll ask someone, oh, yeah, I'm in favor of the state helping people out. Yeah. So you're going to pay for it, right? An extra 10% in taxes. Oh, I don't know about that. I'm kind of stretched thin. So who's going to pay for it? I sure as hell know I'm not going to pay for it. Um, I'm not in favor of that kind of redistribution of capital. It's just not in anyone's best interest based on historic realities of those kinds of wealth distribution systems. Every socialist nation has failed. So anyway, so that's a big trend in the United States right now, and that is certainly scary to say the least. Have you ever moved where, well, we'll do commentary because Yam hits a couple of these. Have you ever moved where you live to pay less taxes? That's called geographic arbitrage. You should move. You should be pretty quick to move within the United States. It's pretty easy to move in the United States. I mean, you don't even have to own a car to move in the United States. You could have a moving company move stuff if you have anything, or you could literally jump on trains and other bus transportation. You could get anywhere in this country without owning a vehicle. So geographic arbitrage is relatively straightforward within the United States because of the way states' borders have been created. And that's back to the beginning of this country. To literally cross borders indiscriminately without hesitation, no friction, no resistance. So why, if one state's asking you to pay 15, 20% tax on your money, you make them $100,000, you got to pay New York an extra $20,000. Why the fuck would you live in New York as compared to Florida, where you have to pay Florida nothing? There's no income tax in Florida. Um, so if in New York, you're getting fucked over by the federal government as well as the state. If you live in the city, New York City, you're getting screwed by the city as well with all their socialist programs. Or you could just literally move to a state where at least you're getting screwed over by the federal government only, and you're not having the state take your hard-earned money from you. So I'm a big fan of geographic arbitrage, and maybe it's scary at first. I know it was for me, and I was a New Yorker for my entire life. But I consider myself an evacuee from that kind of system. I'm grateful that I was able to escape. Uh, I realized that I could leave, and I did leave, and this was many years ago. And you don't know what it's like until you get out. And once you get out, you're like, oh, thank God I got out. Um, yeah, I used to say they say if you can make it in New York, you can make it anywhere. They mean that for a reason. I was at the top of my pay scale in New York back in like 2016, 2016, give or take. It was like $180,000 a year, and I was paycheck to fucking paycheck. I had a $3,500 a month mortgage, and then you had your insurance, and then you had this and that. I was paying $800 a month for transportation just to get to and from New York City. I was paycheck to paycheck. It was tight. and I couldn't get more money because it was the top of the pay scale. I was trying to get 200. I just couldn't. And I left and I came to Florida and I got a job at Universal Studios writing their Android app. And I took like a $50,000, $60,000 pay cut. So from 180, I think I got 130 at Universal Studios. This was like in 2018. Rough numbers, rough. I don't know, but I was taking home in my paycheck more money in Florida than I was in New York. That's how much tax they were taking out. That's how much the extra transportation costs, because that gets folded into benefits. That's how much living in that state sucked the hard earned work out of your pocket to redistribute it for socialist agendas. So, took a massive pay cut, executed geographic arbitrage, and that was the best decision I ever made. There's plenty of options in this great country. You don't have to live in, a very, very socialist leaning state anymore. You could just move and live a completely different life. Remote work is still on the table across this country. Um, it's less compared to where it was back in 2020, but is still very much there, especially in varying industries. I mean, listen, if you're doing customer service for an airline or ticket reservations, there's plenty of that kind of work. You could do that from any state. What they end up doing is they ask you to come and they pay for this type of stuff. They'll say, come on site for training for like a month or two, and they pay for you to come. This is what I've heard. And then that's it. Then you're able to execute your position from home. Okay. So my 2 cents is geographic arbitrage is mission critical. Another component that's mission critical is tax optimization. But that's complicated. And if folks are afraid to literally just move across borders, folks are certainly afraid to do anything with regard to legal documents on their own. That's a shame. I've talked about this for some years at this point, especially with AI. When AI came online, I was like, okay, I'm going to figure something out. And that's what I was able to do. I started writing my own legal documents, do do it using AI to do research and analysis, and I learned oh so much about the U.S. Tax system from Congress, not from the IRS. You don't go to the IRS for the tax system; you go to Congress. That's called the IRC, Internal Revenue Code. Um, and then you go to Treasury for the interpretation of the IRC. That's called the Code of Federal Regulations, and that's that million-page set of rules that everyone refers to when they talk about the government being so bloated with insane rules. And the CFR is interesting, but it's really the IRC because those are the rules as written by Congress. So everything changed since 24. There was something called Loper Bright, which was a case that basically said the de novo reading of the words as written by Congress and the IRC can be done by anyone. You could execute your own lawyerly interpretation pro se. You have the complete legal right to represent yourself and execute lawyerly duties to and for yourself pro se and a de novo reading. And now with AI, you can do some crazy shit. So why not do things? Anyway, so geographic arbitrage and pro se with AI. Do it now. You have one shot at this, ladies and gentlemen, and every day that goes by, it gets later and later. And the sooner you do it, the better you will be. I've been doing. I did the geopolitical arbitrage back in what's that 8 years ago, like 16, 17, I guess, roughly. And then the lawyerly, the pro se documentation and business structuring, that was back in 22, and now we're in 25. So it's been a hell of a ride. Folks on Discord know about that entire journey because they literally have the entire journey. It's all there. And it's been a good journey, a productive journey. And it's not, this isn't bad. This is reading the rules. When you read the rules, you can build things using the rules. I know it's easy to sit around and do nothing and be lazy, and but you don't have to be. Folks could do better. I believe that. And I mean that. The hardest thing to do probably is to ask for help. You know, it's probably the hardest thing to do. And also to be consistent and relentless. The AI can really help with that because you could execute your full spectrum ADHD, which I tend to be. When I find something that I need to master, I do. I didn't go to school for software engineering, yet I had an entire career of software engineering. Some very big corporate names over the years. And then 22, this whole lawyerly thing with the AI. Whatever you do, do it well. There's no reason not to. Good morning, Cap. Much a pleasure. I handled geographic arbitrage. It's a big one. Talked about that. Buying business instead of inflation hedges seems to be best suboptimal from risk return. So bear in mind when you buy a business, the cash flow is inflation adjusted. So that's what I want. So the business was going to appreciate, so it's going to inflate as well. It's going to adjust according to inflation, as well as the cash flow will adjust according to inflation as well. Well, curve is just a part of very significant financial infrastructure that's been built. I happen to think it's one of the most impressive financial products and services I've ever seen, but that's another story. And it's not an exchange. Everyone thinks it's an exchange, and that's because they don't fully understand the path of progression from 2020 to now. Started as just an exchange, a foreign exchange of one denomination to another, but now it's really a full stack, fully vertically integrated stack of financial technology capable of supporting a liability printing, basically a banking system. You can't do yield basis without CRV USD. You you can't have the credit facility of Lamalan without CRV USD. I mean, you can, but it wouldn't be as interesting. So it's different. It's not an AMM. And then you have the drones. Potential for the drones is just gross at this point. Just you get it at the right price, and the rate of return on basis is disgusting. I talk to real estate folks, and they talk about the cap rate. What's their rate of return based on principal appreciation and cash flow? And you're talking like 5 to 12%. And then I come in and I'm like, fine, I got a volatile asset, and my rate of return is probably 70% on basis, um, give or take. I don't know. I think that's the number. About 70% right about now on basis. So I bought X amount of aerodrome, and I'm getting about 70% APR. That's not spot. Spot is displayed. I don't even have it up anymore because I go through autopilot nowadays. But spot is the 20, 30, or whatever percent. But on basis, it's about 70 plus percent. Basis means the price that you purchased at, you acquired position in the business at. That's what that means, ladies and gentlemen. Hope that helps. Buying business instead of inflation hedges. I think I answered that one. Uh, yeah, holding up against inflation. The principal adjusts for inflation and the cash flows adjust for inflation. In other words, wouldn't it make more sense to not take the market risk and just buy a store value asset? Yeah, but then you have to sell it. And then once you sell your store value asset, you don't have it anymore. So you get no cash flow on it. So it's a different story with regard to now Bitcoin and something like yield basis, where you could get double-digit percent APR on a store value asset. That's cool. It's great that I don't even consider it a store value asset. I just consider it a cash that adjusts for currency supply. because it has a relatively fixed supply. That folks loosely called debasement. I don't necessarily can subscribe to these standard terminologies and standard ways people discuss things, but hopefully the way I just described it makes sense. So I don't believe in buying store value assets. I believe in buying productive businesses where the business will inflate and the cash flow will inflate as well. What they would say is nominally adjust, not inflation. Well, it's both because you're in the secular trend of crypto adoption. So I think you'll have both. Um, the amount of currency that will flow through these fintech businesses will increase merely because there's an increase in currency supply on the planet, but also because more and more and more and more people and businesses are using these financial products as compared to traditional banking products. That's my 2 cents. Been thinking about this lately. Seems like we're getting close to a COVID. I don't care about the whole crash narrative, my friend. I don't care. COVID, schmovid, crash this, crash that, global, buy more assets. You get to buy, you're lucky, you buy assets cheap. You're not so lucky, you pay the premium. Over time, you will buy assets cheap. Over time, you will buy assets at a premium. And the rule is designed. So my rules are kind of maybe an expression of how of the things I've learned from Congress. The Congress's rules are very vague. They're very general, very broad in many regards. It's sweeping. So that's the whole point of my rules. Rule number one, own more assets. It's very broad, it's very general. And clearly there's nuances. What? What price? Oh, what asset? What the hell is this guy talking about? But that's not the point of the rule. The point of the rule is some polls on X I did maybe a couple of days ago. Is like, if you bought assets between 2021 and today, do you have more assets today than you did in 21? And some people voted no. Let me find that one. That one was actually disturbing. Yeah, look at this. If you spent the last 4 years buying assets, would you currently have more assets than you did back then? I'm sorry, who the fuck voted no? If I buy 10 assets per week in 20 weeks, I have more assets. What the hell is that? Okay, so that's a cerebral malfunction right there. So just throw that out there. Rule number one, own more assets. And it's as general as that. And if you get it at a good price, that's better. If you paid overpriced, it's not better. It's not necessarily bad because you're still executing rule number one, own more assets over time. Hope that helps. Um, USD is global reserve asset with regard to USD. USD is basically in position to vertically scale exponentially with regard to global use as a settlement currency. As a store of value, it's the opposite, about to exponentially collapse. It's slowly collapsing. Change starts at the margins. This is Luke Gromen territory with gold being an expression of how the change is starting at the margins. But they're selling everything out of the treasury. It's all getting bought. If you have short duration coming out of treasury, if they skew the issuance even more towards the short end of the yield curve, everyone will buy it. They'll buy 1, 2 year, probably up till 10 year. And they'll have to start to taper off of 30 year and 20 year or what have you. And the shorter the duration, people just want it because it turns into cash right away or relatively quickly. It's a cash equivalent, relatively risk free because it's a cash equivalent that pays literally US dollars as cash. Um, so that's why the equation works the way it does. So I do see inflection points, but I see inflection points that just reinforce where things are heading into the future. And what makes me even more confident is most people get it wrong. They're like, "Oh, the dollar's declining in value." Well, okay, you know what it takes for the dollar to decline in value, ladies and gentlemen, in a backdrop where there's how much dollar debt out there that nobody's repaying? You know how much demand there? So if you owe $100 million, picture this, and you owe 3% interest per year, means you need to buy dollars throughout the year because you got a shitload of interest to pay, right? You owe someone 3% on a very large number, and you got to buy those dollars to pay it. So there's your foreign exchange demand, FX demand for dollars. But that's the whole planet. Whole planet's buying dollars, because they literally have to pay interest on the debt that they already have from a long time ago. So there's no decline in need or demand for US dollars. It only increases. So for the dollar to go down, there has to be some basically geopolitical collusion in play for that to occur. And that just kicks the can down the road for Brent Johnson's milkshake, because that's the destination. Structurally, that's just the way it works. It's structurally the destination. And that's the thing that almost no one understands. Like, oh, the dollar's going down in value. The milkshake theory must not be real. Oh my God, dude, you literally don't understand the knock-on effects and the sequence of events and the causality. This causes that, causes that. For the dollar to be going down in value, some serious moves are being made across the planet to such a degree. Um, if you go out to the 6 month, we haven't had the dollar. We haven't had the dollar go down in value since 2008. Ladies and gentlemen, the dollar's been on a good bull market since 2008, and everyone's like, "Oh, the dollar's going down in value." It's finally. It's taken all these years for the dollar to go down in value, and everyone's like, "The end is near." All this decade plus later, insane. It's really insane. But this is a massive structural breach, and I don't care for trend lines too much. But that's cool. I mean, you go to 90 from here, and the move rolls over to the 60s. Man, these markets are going to be weird, because there's your trifecta. Well, the trifecta of bullish confluence would be these yields coming down, 3.5. You start to see a breach of four to the downside, 3.9, 3.8, 3.7, move into the 60s, reaching into the 50s. Oh my God. DXY below 90. Oh my God. If you see that, ladies and gentlemen, you have not seen a bull market yet in crypto. 2020, 2021 was nothing. 2016, 17 was nothing. You've seen nothing yet if you see those conditions, because that'd be the first lower low. That'd be the first lower low on the dollar from a DXY perspective. I mean, you're talking since uh, the not even the 2010s, the early 2000s, 2003. Your first lower low was here in 2003, and that was from 1998 to 2003. Okay, that's 5 years. Now that this pretty compressed. This has been drawn out. The amount of time it's taken for this dollar bull run is historic, at least in the last since the 70s, which is a solid 50 plus years at this point. That's some serious perspective to consider, ladies and gentlemen. Damn, gold 3,800 plus. Arrow, good morning. Always a pleasure. Uber Chad reposted this stream. Thank you very much. Much appreciated. Joel Reynolds, good morning. Fugu, dropping a good morning and a wag me to the one and only Captain Rational. We're all rational at this point. Many of us, at least. Liking the ETH Purpie Circy. Good morning, Cap. Yep, we did talk about the Purpie Circies. That is certainly the case. I like my Bitcoin though. But you because the ETH, everything we own, all the businesses are ETH beta. So if ETH's doing good, everything we own is going to be doing good. And if everything we own is doing good, ETH's going to be doing good, which means Bitcoin's doing good and everything's doing good. And if MOVE's rolling over and the DXY is rolling over and 10-year yields are coming down, then we're all really doing good. Asset, good morning. Arrow, do you think we fall from here and retest lower lows before reclaiming? Don't think too much. Don't think too much. Look at the 6 month on Bitcoin. even if we fall to lower lows. I mean, look, the irony is on the 6 month chart of Bitcoin, you could have a crash down to $20,000, and that would be basically a retest of a previous breakout. Oh my God. Even 65 here, watch. Here's the numbers that are decent from a 6 month candle standpoint. I don't think you get to the 20, but look at this. Look at the 66. You get a break break down to 66. We were at 47 when the ETFs launched last year, and then it crashed to 40, and that was last. Oh my God, that was like 5 minutes ago. To get a breakdown to 67. All right, history says in 6 months to a year, Bitcoin's at a higher price. Did take a little bit of time back in 18, so 6 months, and then we went horizontal, and then COVID. That was 2.5 years. 22. It was only 1 year, two candles. So I think it goes quick now. I like these numbers. Fully leveraged long until we start to reject, and fully leveraged short. Leverage long, leverage short. I don't leverage long nor short. But to each their own. Everyone has to play this game the way they see fit. Joshua, good morning, Cap. Excited for yield basis, but 200 mil is high. Yeah, I wouldn't buy it. I'm happy that there's a little bit of exuberance in the market. I'm happy people is going to catch a bid. That's great. I plan to use it. You throw Bitcoin on it, and you'll get your yield basis token, and you accumulate it just like you did Curve for years. At this point, ladies and gentlemen, um, I'm just as I say often, great. Things people see as an investment. I don't. I might like it. Doesn't mean I'm going to engage with it. I'm not buying that. Buying at $200 million valuation. I don't need to. I'm going to throw Bitcoin on it. I'll get it as yield, and then I'll accumulate it, and the yield basis produces cash flow. So then I'll get that cash flow, and then I'll buy more yield basis, and I'll compound that, and you build a position instead of buying a position, especially with something new. You know, I don't FOMO, and I don't YOLO, and I don't buy new shit. I don't. I buy old shit that has a future. That's what makes most sense to me. Hope that helps. Oh, I didn't post your comment for display, but that's a good observation. I agree. Prompt is promising. Don't know what it is. I honestly have no interest in tickers. I need cash flow. Otherwise, I just have no interest. But thank you. Appreciate it. Always a fine balance between rule number one and rule number two. That's right. That's why fuck you pay me is fundamental when choosing assets. Rule number three plays into the qualification for an asset when you're considering executing rule number one. What do you want? And what characteristics do you want in an asset? Now, the beauty of rule number three is it literally weeds out so much bullshit. It weeds out all the insanity. I mean, technically, could have owned earlier hype if I was a little bit more interested or open minded, but to cash flow investment, it's like the considerations I had for GMX back in the day before Arthur booted it, more or less. Um, Cash flow and a perp. I don't give a fuck about a perp dex. I don't care. I don't like gambling's a business. I don't care. I just don't care. I want credit. I want credit. I want lending. I want exchange, foreign exchange. It's just a perp dex. It's all gambling and shit. I don't care. So that's just me. Recently created a staking memorandum in line with Loper Bright and and Jarrett case. Oh, so Jarrett case is not law. It's still open. Jarrett 2.0 is open still, but Jarrett 1.0 was an interesting one because IRS withdrew the case. That's in. There's nothing you could do in a court with that, but you can hint. Why would the IRS withdraw from a case? Okay, maybe they didn't have an, enough leverage to win. Oh, that's obviously why they withdraw. So if they didn't have enough leverage to win, you can causally state Maybe the merits of the Jared argument were meaningful, but there's no established law. There's no judge's ruling, so it's not a strong argument, but it is at least the start of an argument, especially considering that there's a Jared 2.0. But Loper Bright changes everything. De novo, pro se, that changes the whole equation. So that's the voter escrow partnership, which is very lengthy. It's my longest memorandum. Um, it's also a bit of a stretch because it stretches a lot of things like uh, reporting requirements. That's clearly a complexity, and all this stuff would be heavily contested if scrutinized. Um, but when I wrote the voter escrow partnership, that was really in the context of like not a trust setting. That was just me trying to take whatever a person could do from a personal setting and try and work it into the existing tax code. Um, it was a fun exercise. It's a heck of a document. Um, it has vulnerabilities. It's not as strong as my other documents. My other documents are in a trust setting, though, so it's quite a different thing because a trust setting dates back 100 years. I got court cases going back to the 20s, even earlier, Hale versus Henkel. And that means you have so much more strength of argument. There's just decades and decades of precedents that have been held up over and over again as the status quo. So you're able to craft extremely strong arguments. Um, but I think all exercises are good to do. So if you're playing around with Loper Bright and Jared, that's great. Play around with those cases, and there's more. And now with AI, it's like find me cases that are relevant to Loper Bright. Oh, great. How many? There's about 5 cases that used Loper Bright. Oh, great. There's more precedent. And Jared is kind of on its own, but find me relevant cases, relevant rulings, and then don't forget you find quotes from the cases, from the rulings, and validate them manually. You got to make sure the quotes are actually verbatim. So you're doing case text and all that stuff. There's a bunch of, you get the court case briefs and you validate that the quote is actually the case. Still got to double check AI. But then you use the quote in your arguments. They're using judges' rulings in your arguments, and you're able to produce these extremely powerful documents. That's what so many people should be working on, honestly, as compared to gambling. It's just much better use of time as compared to gambling. I find with increasing regulation, having a structure for ownership of private keys is more important than ever. It changes the entire equation, dude. Always important to be proactive with taxes, going to avoidance versus evasion. Well, evasion is very simple. It's if you clicked around a whole lot and you didn't report it. That's evading a likely tax liability. Avoidance or non-intentional, like if you report and you pay tax and you did the best you can, that counts. Intent is what counts. Um, and avoidance is just a very straightforward concept. Tax avoidance is completely legal. All you have to do is look up the laws and follow the rules and report everything. And you have crafted a business structure in such a way like I could deduct this, this, and this, or this is not income, it's principal because of these, and these rules. So you're crafting a structure to avoid excessive tax liability, but all of that's being reported, and you use your 8275 form for a disclosure, clearly stating. Um, yeah, I'll share with you guys just briefly. Like, here's my 8275 form at this point. Um, it's pretty long. It's about 3 pages, but there's a lot to go over here, and I'm not going to go over it on a crypto stream. But this is all in our Discord forum. We talk about these types of documents, and this is a cute one. And you know, there's argument for both, like inclusion and deduction versus non-inclusion. And I personally think non-inclusion is better because my argument is basically the Jared case. So Jared, and that's what Cynthia Loomis's new tax bill is that receipts from staking, and as much as she's great and all, she's also doesn't understand our narratives, our business narrative. So staking is to them, the politicians, is no different than like staking Ethereum versus staking in Curve. It's clearly very different things. But the point is, you're getting property receipts. And that's what Jarrett's arguing, that these are property receipts. So Loomis is trying to push through that you're getting these property receipts. It's unrealized property. And that is literally, I got 120 pages of years worth of legal documentation to to substantiate that these are unrealized property receipts according to um, especially Glenshore Glass uh, and Eisner v. Macomber realization principle. Glenshore Glass deals with dominion and income, but you need complete dominion, and if you don't have dominion, so it's interesting because a property, is it realized? Is it money? You can't walk into a store and spend property, but it is established unequivocally that all of crypto is property. It's not currency. It's, it's not endless. There's about 5 or 6 concrete statements that it is property from directly from the IRS, including their currently available FAQs page that's live on the internet. So if it's property, it's unrealized. So now we're dealing with basis. Like, what's the basis of the received property from a claim button? I would argue, based on like the voter escrow partnership, that basis is uh, the basis of deposit by the third party into the escrow contract, or at least the fair market value upon receipt. It's not zero. That makes no sense. It's unrealized. And when you realize it, fine. There could be a little bit of an argument that you're realizing based on what basis. So now that there's your counter arguments that you have to fight against. How much are you realizing? You have a claim that's $100. Is the basis zero, and now you have $100 of the income because you're claiming it or you're realizing it, or is your basis $100 because of the way partnership rules are structured, or just the way crypto rules unfold because they're literally writing them as we speak. And that's these are the types of arguments that you can encapsulate in document form to present a position to have uh, increasing leverage, if not a very favorable structure to encapsulate your capital management activities. So it's a nice lengthy document which basically links to my other documents, and lots of here's like big legal basis. Peter would appreciate this. This is a great IRS document, 0331614. Nobody reads this stuff. This thing's been read like 5,000 times since 2001. I've showed folks stuff like this. If you simply go to Google, you pop that in, definition of income, and you go over to here to the statistics, this document is one of the most meaningful documents, in my opinion, in crafting a well-structured crypto trust. And it's been read 8,900 times since well, since the 2004. 21 years. 8,900 times in 21 years, ladies and gentlemen. Nobody reads this. Nobody reads the rules. So I was like, I'm going to read the rule and I'm going to do better. Anyway, hope that helps. Good stuff, Peter. Noah, Captain Noah, Captain. Welcome, welcome. You know the deal. Kano, crypto has an inevitable element of Russian roulette. You can't take the last bullet out of the chamber. I just seem to see people loading extra bullets in their portfolio management. Well, excess diversification. I don't see excessive concentration. Oh, you do. You see people fuck up their portfolio where they do excess concentration into garbage, meme coins and whatnot, and they destroy their portfolio. They blow up their portfolio. Um, so you see these kinds of miscalculations are just complete failures of fiduciary obligations time and time again. Um, it's not roulette though; it's strategic. Strategic plays bets. It's like it's really you place 10 bets. If four of them fail and six succeed, you have a great portfolio. But in reality, with crypto, you probably don't even need six. You don't even need the majority. You just need one or two. So you get one or two that go absolutely parabolic, like you got an early on Pendle or what have you, and that changes the entire portfolio. 1000x, 10,000x changes everything. Hope that helps. JR, much a pleasure. Welcome. Always a pleasure for new folks to stop by. Peter, asset appreciation plus potential for volume increases is the best of the crypto business. Yes, that's the whole point. Crypto businesses are literally principal appreciation. It's literally real estate. It's principal appreciation and the cash flow, which is the cap rate. You talk to any real estate investor, and this is literally second nature language to them. What's the cap rate on your properties? 7%. But what's the cap? What's my cap rate on aerodrome? 70%. And that they're like, what the hell did? What does that even mean? It's like it's speaking an alien language. Move at 74 looks good. Um, it bumped up to 75, so now it's at 74, and that's your double wicks week over week. So it stalled for now. But that's the point. It does look good. We're finally in the 70s. And that's why the market looks so good. And that's why everyone's so wrong because it looks good. Like 2 weeks into this. Actually, it's 3 weeks. 1, 2, 3 weeks into the breach of the weekly 200 to the downside. It's just started. There's been no bull market yet. Oh my God. There's been no bull market yet. That BTC chart just always impresses me. Yeah, there's a couple of different perspectives. Like a 6 month chart is basically just up and to the right. All you had to do was buy more of it over time over the last 15 years, and that would have been the ball game. So nowadays, um, a little bit of diminishing returns, not going to get the multiples. So you buy businesses instead. But now there's this whole robust industry, and the world is converting its existing financial system into these disintermediated, decentralized digital enterprises that have cap rates that are astounding. Earning tokens as yield or greater than buying positions. Well, that's a free position. At least whenever there's an opportunity to get a free position, that's cool. I'm not cool with LPing often because I'm not okay with impermanent loss. So all of a sudden, there's a protocol that solves impermanent loss. I'm gonna be like, all right, that's cool. I'll LP. And stablecoin LPs don't really get you very far. A couple of percent here and there if you get it early, but that dies off really quickly. I just don't LP. I used to. I tried it. I played it, and I just don't like it anymore. Um, yeah, Arrow was also cheap at one point. Arrow was pennies. Oh man, people got in good. Those early Arrow folks, down in the sub 10 cent range. They have this beautiful ranging. You go over to the daily, you see the 100 SMA interaction. Rejection, rejection, break. It's the same chart. Everything's the same chart. Everything's the same chart. Rejection, rejection, breakout, retest. This is a potential rejection, resistance, flip, support. Everything's the same chart. This market looks insane. This market is it's on the verge of something special. I use the reasoning of Jared and some of the case law and reasoning in there. Second reasoning in their second suit. Basically, read their citations and used the good ones. Yeah, exactly. But now I use historic stuff because I built a very traditional type of business entity. So I had a whole lot of additional case law. And now to top it all off, so like I don't even need Jarrett. I don't need the Jarrett case. I have just, decades old trust law that's established that I focus on. And Jarrett's just like, yeah, you're gonna have to all if you want to fight my position, you're gonna also have to fight ongoing legislation because people today don't even agree with crypto receipts as taxable income. They're fighting it left and right. And now to top it all off, I should update my documents and point to Lummis's legislation where I could point out Congress is about to pass law that staking receipts are an income until realized, which is basically exactly what I've been arguing that these are unrealized property receipts. So that's so cool. Unrealized property receipts. That changes the equation. Unrealized. Because what's realization? Realization, um, I mean, obviously you have Eisner v. Macomber where you have like a capital gain. That's another story. But like, for instance, um, why does the 1031 rule exist? Like kind exchange. So if you exchange X amount of WBTC you got as cash flow to stable coins, you stabilize the price fluctuation. So great. So when you realize that as dollars, was that a like kind exchange? What are the rules on that? The BTC to, but it's not like you bought the BTC at $50,000 and you're converting it to stable coins at $100,000. No, you literally just claimed it. You claimed $200 worth of Bitcoin and immediately converted to stable coins, $200 in stable coins. It's the same $200. So there's a whole argument to be had about what's basis, what's fair, not really fair market value, but what's the basis of it? That's the voter ethical partnership type of argument. Um, Gets interesting because there's a lot of laws that date back decades that say very interesting things about that topic. Go figure. I invalidated a Linnea acquisition. Yeah, I did as well. By seeing that its market cap was more than the entire stablecoin supply in Linnea. Is that rational? Sir, that is extremely rational and approved. I approve of that rationality. Sir, yes, sir. Absolutely. Um, we need, well, the struggle that people have is to look for invalidations. There's endless assets. So it's okay to invalidate assets potentially with even less um, substance of an argument, because that's a good argument. Uh, and frankly, I don't. What do I want to own Linnea for? What? So it goes up in price, so I eventually have to sell it, and I won't own anything. So I don't want to own it. I want the cash flow. I want cash flow. You guys get me. So I don't. I don't like anything that I have to sell because there comes a point in the market. There comes a point in the market where you have to sell anything that is not nailed down. Anything that you can sell, you must sell it. It is a fiduciary obligation. You must liquidate anything that can be sold. Okay? We're not there yet. And I prefer to have locked assets so I don't have to entertain that question. And I am A-OK watching the market go parabolic and come crashing down because I expect higher lows after higher lows after higher lows over the next decade or however long of a time horizon I want to contemplate. But that's exactly more or less what I experienced in 2022. It was the drawdown, and I expect the next drawdown. I expect the portfolio to be at a significantly higher level. I am okay waiting 4 or 5 years for these types of market moves. And what I wanted to do in the meantime was not, you can't force a portfolio. So that's literally the antithesis of what I've done. I have the anti-forced portfolio. I have a portfolio that literally is at the whim of the market. It's not like I'm selling something because it's going down to buy something that's going up, and that's the rotation that people talk about, and that's capital gains trading, and I don't do that. So it's the anti-forced portfolio. That is a forced portfolio when you're aggressively looking for something to go up. So you sell the thing that went down, reap your capital gains, buy the thing that's going up, wait for it to top, sell it, capital gains. That's forcing a portfolio. I'm okay with the market producing higher lows and higher highs structurally in a cyclical trend across a secular time frame. Homework for the week: unrealized property receipts. Yeah, that's an interesting phrase, right? So look up Bollinger. That's not going to help. Yeah, here's the voter escrow partnership. Bollinger. Oh, let's here. Do I have any quotes? Oh, look here. Commissioner v. Bollinger, 485. I like this case. This case talks about escrow. I put it in the chat for you, Peter. That case talks about escrow. Go figure. And that's exactly what we're dealing with here, right? Voter escrow. Therefore, it's an escrow. Therefore, it's an agent, an escrow agent. So, what are the rules for escrow? That that was an interesting one. So, the Bollinger case is highly relevant there. So, basically, Bollinger says the basis of property uh, does is retained between the escrow agent and the recipient, because the recipient is by proxy the recipient at the escrow level when the escrow agent receives the property. So you get it. Here's the recipient, but here's the agent. So when the agent receives the property, it's basically on behalf of the recipient. So they already received it. So it presents an interesting uh, sequence of events where you have basis preservation, because if the seller, the person contributing property to the escrow, which is basically someone executing a trade, and some of that capital is going into the escrow contract, they're experiencing a capital gain. So they're taking their original basis, $100 Bitcoin, and they're selling it for $200, and they're paying the tax on the capital gain. And that $200 worth of Bitcoin from the escrow agent is getting distributed to the recipient, $200 worth of Bitcoin. The basis is retained basically from the contributor through the escrow agent to the recipient. That's my interpretation. Pretty sure that makes a great deal of sense because Bollinger never talks about who the contributor is. Bollinger doesn't distinguish between if if the recipient is the contributor to the escrow contract or a third party. It never talks about that. What Bollinger is focused on is the relationship between the escrow agent and the recipient, and that there was a preservation of basis. So my stretch of an argument, or my way to push that a little bit, is introduce the idea that it doesn't matter whether it's the recipient contributing the property to escrow or a third party. Why is the third party contributing? Well, it's not necessarily out of goodwill. It's because they're engaging in a contract, and that contract is intentionally siphoning off a little bit of capital. You could call it a fee, but it's not a fee. Really, conceptually, people in crypto talk about these things in terms of fees, but really, it's a software contract executing immutably and siphoning off a little bit of capital, a little bit of property. So at the contract level, are these really businesses? I don't think so. On the contract level, that's something I argue that these are just deterministic rules and migrations of capital based on predefined pathways. these contracts have no idea that these are analogous to businesses or comparable to businesses or what they're doing. All these contracts are doing is shifting around property from different parties to different parties. So that's somewhat of what I argue. It's a decent sized document. I think that thing's almost 30 pages. Um, has your old rule, picky to buy, quick to sell, evolved into picky to buy, then stop buying? Yeah, more or less. Picky to buy, quick to sell. Picky to buy. So my yeah, because that's more of a capital gains methodology. Quick to sell. My once you get and it could be many thresholds. It's a subjective threshold, but the logic is very simple. If you have assets that are producing $500 a week, in 10 weeks you have $5,000. That means if you take $3,000 and buy an asset, buy a business, start building a position, and $2,000 is used for what? Groceries and whatnot, real world expenses. Um, that's just rule number one. I bought more assets. So you bought assets that produce cash flow. The cash flow is equivalent to a paycheck. You don't spend all your money, you don't reinvest all your money, but you have to buy more assets over time. And that's how I think about these things. I think about the cash flow as just the same kind of cash flow from a salary from work. And over 5 years and over 10 years, that cash flow will grow into something meaningful. And if you're in your 20s, you're lucky that you found crypto in your 20s because by the time you're 30, if you're 20 right now, by the time you're 30, I think you're done. All you have to do is compound and do boring stuff like DCA and just put your cash into an aerodrome or velodrome relay that auto compounds or do it manually, whatever. In a decade, my God, you'll be grateful that you bought your assets at the age you did. Eric, that being read 8,000 times in 21 years is a wild stat. Thanks for bringing my attention to this. Nobody reads this stuff. That is the most one of the most meaningful documents. It's basically IRC 643B, and that is one of the most controversial IRC codes I could probably think of in my field of interest. It's the definition of income. That's a meaningful thing. The definition of income. You would think that that's a much more popular document. Maybe not, according to the stats. Not so popular. Unfortunate for so many. Using trust law, oldies or goodies, the old established stuff. And you could argue that the new stuff isn't necessarily applicable, but then they have to overturn it and they have to set a new precedence, which, you know, that's not something a lot of judges want to do is just blanket overturn like 50 years of precedents. So, especially when there's confluence of cases that have different nuances, like three or four cases that basically support the same argument, you're just going to blanket overturn four cases in this context? Ooh, goodness. So, that's a strong argument when you have four cases and four different judges with language, quote unquote, verbatim that supports an argument. Peter with the fire. Thank you, my friend. Appreciate it. Not easy. I never said any of this was easy. But what I will always tell you, ladies and gentlemen, is you could do anything, especially now with the AI, because you have someone to talk to. That's the most important thing. The first step to fixing a problem or doing better at anything is asking questions. So now the fact that you can ask questions to an AI, that changes the entire equation. You should always ask questions to yourself also, but now bounce it off the AI because it's just so smart. They're so incredible. They really are nowadays. And that's just recently. They were a little difficult at the beginning. They hallucinated a lot. And I found it a little counterproductive, a little frustrating that I had to manually verify everything. But nowadays, it does the research. It finds the court cases. It does the analysis. It's just insane what it does nowadays. Recently, a lot of my documents, amendments to trust are based on really breaking down what's happening from a smart contract and technology standpoint because much of what's happening is not properly understood. Exactly. The nuances are so incredibly applicable to traditional financial scenarios. And guess what? There's an entire sector of law called partnership law. And it just so happens that voter escrow is literally a partnership. So my entire voter escrow partnership memorandum, well, a good part of it is dedicated to saying that even though this is not an established partnership, the fact that it conforms with the definition of a partnership is all that's required for it to actually be a partnership. And the fact that it cannot comply with filing requirements, that's separate and apart from it actually being inarguably an established partnership according to the definition of what constitutes one. So it introduces a lot of questions, fair amount of uncertainty, but it frames the entire reality of what we do in a way that's novel. I'm okay with that. A lot of people are afraid of novel. They're like, "Oh, this is untested. No one's ever done anything like this." And this, what I do when I hear that, I'm like, "Goddamn right, it's untested. I like that. Do something new. Be bold." That's the way to live. Always live pressing for change, pressing for something new. Dare to be different, whether it's be the first person in your family to own assets, first person in your family to buy stocks, to buy crypto, first person in your family to go to school. So be it. Be different. And that's just such an exciting thing to be different. Just saying, my 2 cents. Much a pleasure, Peter. Monday, September 29th, 12:42 p.m. Start of the week. I think this will be an interesting week. I think Q4 is going to be interesting, and October's coming up in like 5 seconds. So there we go. I think it's off to the races at some point. I don't think there's been any bull market at all, and that's based on a dollar, a DXY, and a move bond market volatility inspection standpoint. Has nothing to do with the price appreciation of Bitcoin or what have you. That's irrelevant. I'm talking about structural, global financial, structural, that perspective. That's what matters most to me. And there's been no bull market from that perspective. Uh, what's going up together? I don't know. Oh, Treasury General and reverse repo. Um, yeah, don't bother yourself too much with that shit. It is significant if the Fed announces QE, because right now they're still tapering. That's meaningful. I don't give a shit about Fed rate cuts. I don't care about the Fed rate cuts. That's a lagging indicator. The market saying, "Hey, Fed, you got to cut. You're crazy," because that's what the bond market's telling it to do. So, with regard to the, you know, Treasury General and reverse repo, I guess you could look at net liquidity. I still have that up. Here's net liquidity. It's basically down. It's down for quite some time since August. Not too interested in that. Arthur loves that perspective. Oh, the net liquidity, Fed net liquidity. No, no, don't worry about it too much. You hear the Fed talking about stopping QT. That's getting interesting, or starting QE. That's interesting. Don't call it the money printing though. They're basically becoming a buyer in the Treasury market, and that means that drops yields. And if they're dropping yields and moves rolling over and the dollar's rolling over, there you go. So they basically influence the third component, which is why I have these three up here. The third component of what I look at to basically tell me when the market's about to go absolutely monumentally parabolic. Yields come down, move crashes, DXY rolls over. There's your bull market. We have had no bull market thus far. Thank you for joining me today, ladies and gentlemen. 283 people made it to the end of the stream and are all now that much more rational because of it. Stay calm, cool, and collected throughout the week. We'll have more to talk about towards the end of the week on a Friday. Until then, obviously, I'll have plenty of stuff to mull over and think about on X, as always. See you later this week. Until then, peace.